JC Parets, founder of Eagle Bay Capital, joins us every Thursday to give us his perspectives on the market. JC, thanks for joining us. How you doing today?
I'm doing well. How are you guys?
We're doing good. Let's just go to the broad market here, and 40-point plus intraday rally in the S&Ps. We did go down to that support level again. Just got a tremendous bounce. Just from your experience, your technical perspective, is that a healthy move, or is this kind of a crazy move?
No, I think it's normal. We got down to the bottom of the range and we bounced. I would have been surprised otherwise, particularly with an upward sloping 200-day moving average. You want to look bigger picture and the overall trend. Longer term, it's up. Short term, like we talk about every Thursday, we're in the middle of nowhere. I mean, we continue to grind sideways, and like we always talk about, if you're trading the averages, you're going to get average returns. So, I would have expected a bounce off of those lows, and we got it. It was pretty vicious. So now what you want to see is upside follow through. That would be big. If we don't get upside follow through and we roll over, I think that would be disastrous in my opinion. Because when you get one of those candles, the Japanese like to call them hammers. The reason they call them that is because the Japanese say that the market is hammering in a bottom. So when those hammers don't hammer in a bottom, if you will, and don't follow through the upside, the market is speaking and telling us that we're going a lot lower. So I think when you see a candle like that, you gotta see follow through. So that's what I would look going forward. If you're a bull, if you're a bear, you definitely want to see a rollover. Either way, I think the market, the market will tell us what's up over the next couple of days.
What did you make of the oil stocks rally yesterday? Because oil really wasn't up very much. It's actually kind of down even here this morning. But you saw Exxon, Chevron, you saw Conoco, you saw all your big oil stocks really catch a bid there yesterday and all close near the highs. What are your thoughts like Exxon, Chevron, the big guns?
I was tweeting about it earlier in the week. On Monday, I was tweeting about it. The 161.8% Fibonacci extension of the most recent rally in XLE from March to May was exactly where we bottomed out. So I love it. I think it's great. I really love it when the market respects those Fibonacci extension levels. I mean, there's a reason why we follow these. There's a reason why we pay attention to them. Did a bullish momentum divergence. Market, stopped going down at that key Fibonacci extension, and we rallied hard. I love it. It probably goes higher.
What about gold? Gold caught a little bit of a bid, but right back down here again today, getting the beats. What are your thoughts here just, overall on gold?
Yeah, same exact thing. If you take the most recent rally in gold, same thing from March to May, you take the 161.8% Fibonacci extension of that, and sure enough, that's exactly what the lows were a few weeks back. Can't say I'm surprised. Now, let's remember this. I think it's important to recognize and define what your time horizon is because, yeah, I mean, did we hold that Fibonacci extension level? Are we bouncing from there? Of course. But I said from the beginning that, if we do hold and we do bounce, I would be fading 1140, which was the former support. So I still think that. That hasn't changed. So that 1140 to 1160 level, if we get up there, which it looks like we're going to, I'd be fading that because the overall trend is still lower, and I think that we ultimately roll over and see $1,000. So, yes, this is a nice move, tradable, 100%. But remember, this comes within the context of a major bear market. So this is counter trend for sure, at least for now, anyway.
Okay, JC, just like the market, Apple hit that support, big rally out of it, led the market higher. Bro, it's down to its 200-day moving average here. I know you've been very tepid on the stock. Have you been getting a little bit, looking at it on the long side at all?
Nah, I mean, I love the fact that it broke down. We've been talking about this for a while. If this was a bull flag and this was something that was going to break out to the upside, it would have already done so. The market, there's a lot of symmetry to the market. And if this was going to break out to the upside, it probably would have done so in May, early June at worst. So the fact that we got into July and still hadn't broken out, the market was telling us it's probably not a bull flag. It's just probably, overall, kind of distribution, if you will. So what do we do with it now? It's below all this broken support. 200-day moving average is flattening out. Momentum is in a bearish range. I mean, I see no reason to be involved in this stock on the long side, both from a long-term perspective, especially from a long-term perspective, short-term horizon. Again, dead money at best, I think. The opportunity cost in this thing, if you ignore those Fibonacci levels that we've been talking about at $130 since February, think about that. We've been talking about this, and you guys ask me about this every single Thursday, and I know because your viewers and your listeners like to hear about Apple. I mean, everybody wants to hear about Apple, so we talk about it every Thursday. And I've been saying how what a waste of time it is, looking at this thing, and it continues to be. I see no reason to be involved in this at all. At all. The opportunity cost has been extremely expensive. Oh, what a disaster this has been if you've been in this since February. I still don't see any reason to be involved, even less so now that we broke down from this consolidation. I mean, Apple's got a lot to prove for me to waste my time with this. Definitely.
JC, you've also mentioned you think Twitter is dead money. Of course, there's been a lot of fundamental news on it lately, but technically, what are you looking at in Twitter?
It's a mess. It's a disaster. I mean, I love the fact that, people that get paid to make noise instead of people that get paid to make money, people that get paid to make noise love just talking about how their sources talk about a buyout in Twitter and how their sources are so reliable and all this nonsense. And Twitter's down, 30% in a few weeks since those sources were telling them these things? So for me as a market participant, I love to see that because supply and demand, once again, is what moves the markets, not sources or whatever the case may be. So the problem that I see in Twitter is that we're below all of this former support since last December. Let's call it $34 for argument's sake. We're below all of that. We're below a downward sloping 200-day moving average. The trend is clearly down. It's a broken stock. There's a lot of supply overhead. So the problem is that any rallies that you're going to get are going to be met with that overhead supply. That's the problem. So, if we do get a rally into the low 30s, 30, 32, 33, 34, I'd be fading that. It's not for me. I can't do it. I wouldn't touch this at all. I wouldn't short it here either. Our downside targets have been met, so I think it's a no man's land. I'm more of a, looking at this going forward, I would rather be just a seller of strength.
What sectors?
If for some reason, and thank the Lord that I'm not, if for some reason I was stuck in it long, I would just take any opportunity in the low 30s to get out of it.
Okay, JC, what stocks are on your radar right now that don't have that overhead supply that you think are going higher? Because obviously, if the market, it's just sitting around here, but there is stocks always making new highs. Which stocks are on your radar?
I'm not very bullish. I'm not. I'm very
Uh-oh.
neutral. If anything, I would be looking for. I would either, I think that we do get some upside follow through in energy. I still think so. I think we've got some upside follow through in the gold miners. Again, these. Just because there's overhead supply, just because these are ongoing bear markets, doesn't mean that we can't get counter trend rallies.
Right.
In fact, the counter trend rallies tend to be the best rallies overall, right? Look back in history,
Short squeezing.
back 100 years, the biggest, most powerful moves that you see come during the worst times. They come in 1929, they come in 1987, they come in 2008. Those rallies tend to be during bad times. Those are the best rallies. So yes, I think miners, gold miners still have upside. Energy still has upside. All the garbage, I think, still has some upside. If you want to look bigger picture, some of the nicer ongoing trends, you got the S&P 500 hitting 12-year highs versus emerging markets. I mean, that is, one of the most powerful trends out there. Bigger picture, I would want to be buyers of dips in that trend and that ratio. That by far and away is one of the strongest trends on earth. I'm looking at healthcare maybe for a rollover. That's been a big winner for a long time. I don't think you could be short if we're above 75, which we currently are. But if we start rolling over below yesterday's lows, I think we can get aggressively short healthcare. I really do.
JC, what about a stock like Netflix? A lot of people trade it. It's been in a huge uptrend, obviously, here. It feels like forever. Got up there, kind of just got up to the 129 areas, pulled slightly off there. I guess you could call it a little 50% retracement of the most recent move here. Is this a stock that just moves higher?
And like we talked about, I had that target of a little over 700, which adjusted was about $100. And that was our target. So for me, I like to be disciplined. So there's no reason for me to be in this at this point. I wouldn't be buying it simply for the reason that, forget the fact that our upside targets have already been met. Let's just say that they didn't, and this is the first time I ever looked at stock in my life. I don't know where to define my risk, right? At what point can I say, oh, I'm wrong? I don't have that. So that's more important to me than where I think it's going. Number one, I don't know where it's going, how high it can go. Number two, and more importantly, I can't define the risk, right? You see where I'm coming from? What price do I say I'm wrong at this level? I don't have that. It's a good example of that was Tesla in 2013. The thing was a monster, right? Monster. And I never traded it because it was impossible for me to quantify the risk. So on a stock like that, I compare Netflix today to Tesla in 2013. Is it an uptrend? Is it probably going higher? I've gun to my head, it probably goes a lot higher. I just don't know how high, and more importantly, I can't define the. So it's just not for me.
JC, I saw you tweeted earlier this week, you like this China currency thing. What are your thoughts on them devaluing the yuan, and how are you playing it if you are playing it right now?
I think it's great because it just increases volatility. It increases uncertainty. It creates opportunities, right? So, socially, and morally, do I think it's a good thing? I think it's probably horrible. I think everything that's happening in China is horrible. They have all of, not that this is my area of expertise, but just, common sense, the fact that they just build cities that nobody lives in, they got 20 of these things. These are just massive cities, ghost towns. I mean, I can't possibly imagine this is going to end in a good way. The fact that they're devaluing their currency and, manipulating their market and, all of these things, I think that's all horrible. I think it's going to end really, really badly. I mean, they're commies. They don't understand capitalism. The things that we take for granted when we wake up in the morning and we know that we can, if we work hard and we do the best we can, there's a higher likelihood that we're going to be more successful than people that are lazy and don't do as well. That's just, things that we take for granted. So I think that what they're doing over there, I think is a disaster. I think it's horrible. Now, putting that aside, as a market participant, it's two completely different angles. I think it's great. I think everything that's happening over there, the fact that it's a disaster, the volatility out there is creating volatility here in the States. I think it's great, simply for the reason that it creates opportunities. And, again, getting back to capitalism and supply and demand, if there are more opportunities, there's a higher likelihood that we're going to be able to take advantage of those opportunities. So I'm a huge fan. And I hope they, selfishly as a market participant, I hope they continue to screw things up because it's just going to create more opportunities for us, right?
I like volatility too. As a trader, JC, I'm right on board with you. I love volatility. What about these financials? Just one more sector to talk about here. Just want you to interpret yesterday's action because most of them broke down through support. You can look at like a Morgan Stanley, which was trying to hang around support that had made it low back in early July. It took that out hard, but then they bounced and got the whole losses back yesterday. I mean, really, when talk about this bounce back in the market, the financials were a big part of that. And you look at even a stock like Bank America, which at one point yesterday was down almost to $17, bounced all the way back to $17.50. Is this just a snapback rally to short here, or do you think, there's something to this financial rally?
A couple of weeks ago, all of our upside objectives and financials were already hit, particularly in XLF. 35 and change off the top of my head was our upside target, and that was finally hit. So for us, we're totally neutral. I'm not bearish. I'm not bullish. I have zero opinion on it at all. The one thing I would say is that regional banks underperformed tremendously yesterday. I think that's an interesting tell. So the fact that financials have hit our upside objectives and regional banks didn't bounce back like some of the other sectors or some of their financial counterparts, I think is a big tell. And if you look at XLF relative to the S&P 500, everybody talks about how great financials are doing and how wonderful they are, but they're still in a multi-year downtrend relative to the S&P 500. That hasn't changed. I get that we've seen some relative strength more recently, but bigger picture, we're still making lower lows and lower highs relative to the S&P 500, and there are other sectors that are not doing that, like consumer stocks, both staples and consumer discretionaries outperforming. You know, you have healthcare technically still outperforming. So when you have a sector like financials that I consider to be arguably the most important sector in the market, in underperforming over the last couple of years, and that hasn't changed, you know, I can't get behind that. It's just not for me. You know, why they hit our upside objectives, underperforming the market? Like, why am I going to mess with these things? You know, I get people obsessed with them, and they love Bank of America for some reason. You know, I don't know. I look at a stock like Citigroup; it's gone nowhere since 2009, which is unfathomable. The fact that a stock like that has gone nowhere. You know, we're in the biggest bull market arguably ever, and Citigroup is flat since 2009. You know, I look at things like that, and that just bothers me. So it's just not a space that I want to be in. I think there's better places to be.
We've been on the line with JC Parets. He's the founder of Eagle Bay Capital, 10-year market veteran, also an excellent technician. He joins us every Thursday morning. JC, thanks for coming on today, and we will talk to you again next week.
Always. Thanks a lot, guys. We got them.
Thanks, JC.